Now, the question is, what do we expect next year, 2003? Peter Churchouse, Managing Director and also Head of Research for Morgan Stanley in Hong Kong, joins us for his take on this. Peter, good to have you with us. Now, I guess before we go any further, and this is a little bit risky here, we don't want to get caught out, but I mean, this is taped. Whatever views you have or assumptions that you have for the 03 year for Wall Street, does that or does it not include a U.S. intervention in Iraq early part of the year?
Well, our base case, of course, basically assumes that this, if it will happen, even does not have a huge impact on the global economy. The base case assumes that any action in Iraq would be pretty short and over in a pretty small space of time, just as we saw in the Gulf War in the early part of the decade. So that's our base case scenario.
Okay, I'm just wondering, though, I mean, just as we've got commentators saying that the markets have really read the Fed the wrong way and perhaps are giving the Fed a little bit too much credit in terms of when the hiking cycle will start again. Similarly, do you think markets are a little bit too optimistic about a war second time around in Iraq being clean, swift, fast and easy? I mean, conditions, I mean, so many things are so different this time around.
Well, that's right. I think the market has discounted a pretty quick event in Iraq, if it happens at all. But of course, the risk is that it may go on. But if we go back in time, what we found with these events in the past is they have not had a big impact on the overall economy, both in the U.S. And in the global economy. So I think people are looking at that as being the sort of the comforting factor here, even if it is a slightly prolonged event. Particularly with oil prices. Last time we saw a spike in oil prices. It didn't last long. Production came back on from other areas, and oil prices dropped right back. So that's the sort of thing I think people are looking at.
Are we going to see an earnings recovery next year? Are we going to see CapEx finally kicking in there? I mean, that's sort of the last link, the last leg that everybody's been waiting so long for.
Well, definitely we're looking to see earnings pick up next year. Corporate earnings growth, reported corporate earnings growth next year, we're looking at about 15 or 16%. So that's a pretty positive scenario going forward over the course of the next year. However, having said that, though, the U.S. markets are not cheap. We're still trading way above average valuation levels on just about every valuation you want to look at. Price to book, price earnings ratios, price to cash, etc. So I think that's the risk here, is that investors are not going to be prepared to pay for those earnings growth, even though those are pretty robust numbers.
What is the best way to play it, even if it is still looking a bit rich?
Well, our sense at the moment is a slightly pro-cyclical bias, still in the cyclical stocks, but reasonably stable stocks such as healthcare, for example, consumer discretionary stocks. But we'd be kind of moving away from the very defensive stocks that have been so good in the last year or two in terms of relative performance, the utilities, and we're sort of lightening up on property sector, which has been a great performer over the last couple of years. So a little bit of a switch into the pro-cyclicals, and also looking a little bit more at growth. We've been very much out of growth stocks into stable earning stocks, but I think now with this recovery in the economy, recovery in earnings growth, we think we should be perhaps taking a bit more of a push back into growth stocks.
All right, sounds like a pretty good story for corporate America there, but if we trace it all the way back up the food chain, it seems like what you're saying is we are going to see a nice recovery in the U.S. as far as monetary policy is concerned, what the Fed does. When do you see the Fed starting a fresh cycle of hikes up?
Well, I think at this stage we're a long way from that, quite frankly. We don't expect to see any real signs of inflation in the first half of next year. The monetary policy, fiscal policy traction is just starting to kick in the U.S. right now. We're seeing good productivity gains. We're seeing real wage increases of 1.5% to 2%. There does not seem to be any incipient inflationary pressures right now. So I don't think we're facing any risk of a major upside in interest rates in the short term. And in fact, any rise in interest rates may actually be quite positive for stocks, for the simple reason that it suggests that the economy is doing well and profits are picking up. That's what we're looking for. We're looking to see companies re-energize their profit and loss accounts, and so that could be a good sign.
All right, sounds pretty positive. Peter, hold that thought. We'll be back to talk more in just a little bit there. We're also going to bring in John Richards, Barclays Capital up in Tokyo, talk more about the Japanese market, see whether there's going to be any life there next year. We'll be back in 2. Let's get over to Peter Churchouse now. He's been staying with us from our studios up in Hong Kong. Peter, you've probably been listening in what John has been saying about the Tokyo market. What do you figure?
Yes, what interests me, of course, that John didn't really talk too much about was the yen, because this policy we see at the moment in Japan of a deliberately weak yen putting pressure on other countries around the region, that, of course, I think a weak yen could perhaps prove a little negative for markets like Korea, which I think could be affected by any policy which looks to drive the yen weaker.
We'll take a quick break, though, right now. When we come back, Korea, we mentioned, really started the year 2002 on fire, the envy of markets, or a lot of them around the world. But, investors started losing faith in Seoul, and the market rounded out the year pretty flat. Get back to Peter and talk more Korea when we come back in 2. Don't go away. Okay, let's get back to Peter Churchouse, Managing Director, also Head of Research for Morgan Stanley, staying with us from our studios up in Hong Kong. We left off talking about the risks in this market. We just ran through several of them in the piece that we just put to air. Household credit got a bubble there, housing bubble possibly. But I want to actually pull an even bigger picture and ask you, a new president, what that might or might not mean for the market. What do you figure?
Well, it seems, quite frankly, the two leading contenders in the presidential race don't really have a particularly different economic agenda, it seems. And given that the previous administrations had a very, very successful record over the last few years at pulling Korea out of the Asian crisis that evolved in 97, 98, I don't think you're going to see a huge divergence from existing policies. I think where the big problem potentially lies is regard to policy vis-a-vis North Korea and the U.S. And that's where I think we see the big differences, not so much on economic policy.
All right, fair enough. So in terms of broad brushstrokes there, pretty much same old there. But what about these risks? Household credit bubble, housing bubble, I mean, is it going to mean, we've seen authorities cracking down already, but in terms of monetary policy, which will affect the market, is it going to mean they're going to have to ratchet rates up higher, tighten things up, or with the external risks, not least the U.S. and a war in Iraq, are they going to have to ease rates?
My sense here, quite frankly, the Koreans have enough firepower and reserve economically to actually embark on a fiscal easing next year. We do certainly see the risk of a credit crunch. It's actually happening. And I kind of think that Andy Shea, you mentioned earlier, may actually prove right here that there will be the scope to ease interest rates next year, but there will be administrative controls put in place to cut credit card debt and cut credit card advances and cut property lending. This can be done with administrative controls and ease the pain of that by lowering interest rates. They can afford to do it. They've got a current account surplus, they've got a budget surplus in Korea, and that may well be the way that they go about this. I think that could be a positive spin on the Korean economy next year.
All right, fair enough. That sounds pretty good. But a couple of minutes ago, we talked about the yen. You saw it down to 135 averaging for 03. As far as Korea goes, I mean, it could, of course, cut both ways. It could help their exports, but at the same time, they're a net oil importer. So, I mean, net, what is the effect of a weaker yen and therefore a weaker won going to be?
Traditionally, a weaker yen is not good for the Korean exporters, as we all know. They compete very directly with the Japanese. However, I think what's most interesting at the moment is about 80% of Korea's export growth over the last year or two has been going to China. So it's very much switched its focus in terms of growth of exports to China rather than to other markets. And I think that's perhaps going to be less affected by the yen considerations. So we're already expecting, even now with our yen forecast, we're expecting exports to drop next year to about 6 or 7% growth as opposed to 8 to 9% this year. So we're already factoring that in, but still expecting to see reasonably robust export growth from Korea into China.
Okay, Peter, let me put you on the line here. Back everything you've said with, if you could, groups, themes, plays, even specific individual names for next year in Korea.
Yes, we kind of favor at this stage some of the materials and basic cyclical stocks. For example, steel. POSCO is trading somewhere around about 9 times earnings. We're growing at 20-odd%. We look at the chemical sector, Honan Chemical, LG Petrochemical, again, stocks that are going to grow earnings probably something north of 30% this coming year, trading below 10 times. These are pretty cheap stocks with decent earnings growth. Also KT, Korea Telecom, again, probably going to grow about 14-15%. trading at low double digits, 9, 10 times forward earnings. We kind of like these names. We're not particularly focused in the technology area.
All right, good stuff. Peter, off to leave it there. Good to talk to you, sir. Peter Churchouse, Managing Director, also Head of Research for Morgan Stanley from our studios up in Hong Kong.